Welcome to this very important session on the formula for successful investing. Yes, there is a formula that tells you all the secrets of investing that you need to know. And it is so amazing that Einstein called it the eighth wonder of the world. Imagine that. And it is something we all learnt in class 7th or 8th as the compounding interest versus simple interest formula. Unfortunately, it was presented as just another mundane maths formula without any capability to impact our lives. Let's see it now with fresh eyes. This is a formula to calculate compounding. All you learned then was that with compounding interest, the banks paid a little more than simple interest. For example, 5% simple interest means you get rupees 5 every year on your 100 rupees. And in 5 years, your 100 rupees becomes 125. With 5% compounding interest, it will become 127 rupees 60 paise. And I wouldn't blame you for thinking that this was no big deal. And that's not going to do anything. So even today, if I say the formula for successful investing is compounding, most people think, yeah, I know. Trust me, most people don't know the power of compounding. It has the power to enable you to fund all your responsibilities and dreams. Yes, I mean that. To fully understand this, you must stay with me till the end of this session. So first, I'm going to call this the wealth building formula. So you can think about this differently and get excited about it. As you can see, there are 3 variables in this formula. Surplus or savings that you put to work, the rate of returns, and finally the number of years you stay invested and earn these returns. Let's look at what this tells us about how to manage our money and how to invest. First, if you're young, in your 20s, you are the luckiest ones because compounding is most generous to young people. That's because they have the longest time period for which they can stay invested, and that can do wonders. Look at this graph. If you invested just 1 lakh every year, which is roughly about 8,300 a month, from age 20 to 40, and compounded that at 12%, and then stopped investing fresh money, by the time you are 60, you would have rupees 7.8 crores. If you started only 10 years late, invested from the age 30 to 50, you would get 2.5 crores. And from 40 to 60, you would get just 80 lakhs. In all these cases, you invested for the same 20 years. But if you started investing early, compounding works harder and longer for you, and this extra time that you have for compounding to work for you will not be available for long. So if you are young and have started earning, after knowing this, the action for you is very clear. Save and invest right now. The big benefit of starting early is you would have built a corpus that can allow you to have more freedom later in your life. For example, that early retirement dream doesn't look all that very difficult now, does it? For those of you who are older, the important takeaway is to start investing right now with earnestness, because delaying this any further is going to make wealth building for you even more difficult. And remember, we all live a little longer now. So even if you're 40 or 50 years old or young, you probably have another 40-50 years to live. So start investing sincerely and systematically right now. And yes, those of you who have children, don't forget to teach them this lesson and ensure they don't miss out on this wonderful possibility. Now let's see what we can and should do to improve upon this. The next thing to do is to save and invest more every year. The simplest way to sort this out is to put aside 10 to 20% of your salary as soon as you receive your pay and learn to manage your expenses with the rest. Those of you who are having trouble accepting this, imagine you didn't get any increment this year or you only got half of it. The more you can save now, the earlier you can achieve financial freedom. And the side benefit is that you get smarter about how you spend your money today. There is no reason to think that this is going to reduce your happiness. It's more likely that you will become better at getting more out of what you spend. The impact of this you can see in this graph, which is the same as the earlier one, but modified for saving and investing 10% more every year. you can see that the corpus increases from 7.8 crores to about 15 crores and 2.5 crores to 5 crores and 80 lakhs to 1.5 crores. The interesting thing is that even after 20 years, the annual investment that you make increases from 1 lakh to 6 lakh. Humans by nature are in discipline. So saving that 10 to 20% of what you earn every month can be a painful decision every month. The urge to not do it in a particular month can be very hard to fight. So sooner or later, you're not going to do it. The good news for you is that you have all kinds of automation options available. Automate your savings decision so it goes out from your savings account without requiring your action and decision every month. Just start an SIP and auto debit that amount from your salary account. Now, having got the tough part of wealth building sorted out, let's see how we can make our money work harder for us. And that brings us to the third key variable in the wealth building formula, rate of return. Savings is not enough. If you save 500 today, you can't buy the same goods and services 10 years later with this amount. Say a pizza in a good restaurant costs about 500 rupees today. It is unlikely that this pizza will cost you 500 rupees 10 years later from now. Suppose every year the price increases by 5%. 10 years later, this will cost you 820. This general increase in prices is called inflation. It acts like a tax on our saving, reducing its value as time passes every year, year after year. If inflation is 5 rupees and you forego this 500 rupee pizza today, you must earn 5% interest on it every year to be able to afford it 10 years later. This is roughly what your fixed deposit does. Now, that does not sound very appetizing, does it? You need to do better than that. And that's why you need to invest in assets that earn more than 5% return. So, investing has to beat inflation. What if you earn 10% return for 10 years? How much would your 500 rupees become? It would become about 1300 rupees. And after paying 820 for the pizza, you would still have 480 left for something else. We call this wealth creation. But for now, look at how your money grows when you earn inflation beating returns. Look at the 6% line, as this is a line for inflation and also what fixed deposit will grow at over the years. In 30 years, it will grow to a little less than 6 lakhs. Now look at the 8, 10, 12% lines. At 12% CAGR, it will grow to 30 lakhs in 30 years. The difference is huge. Or, if you're clear that you want the same pizza after 10 years, you would need to save only 316 rupees today. So, earning returns that beat inflation means you can save less than what it costs today and still meet your goals. We will see more on this in the next session on financial planning. Now, the obvious question in your mind will be that earning higher returns will grow your wealth faster. And that's what most people wrongly conclude with the compounding equation. Yes, it's mathematically correct, but in the real world, there are no free lunches. You cannot earn higher returns, especially above the market returns, without taking higher risk. The consequences of gunning for higher returns is that it adversely impacts the other two variables in the wealth building formula. That is the amount invested and the period one stays invested for. And hence, it is unlikely to generate wealth. When you take higher risk, you invest only a fraction of your net worth simply because you cannot take risks with your life savings in what seems like a gamble. Secondly, when you have risky assets, they tend to correct more sharply when the market corrects or falls, or there are some bumps in the economy or in the company's performance. When you have significant money invested in these assets, you, or for that matter, most people become very uncomfortable, even panic, and sell such assets. Simply put, you cannot stay invested for very long with such risky assets, and you don't get the benefits of compounding for long. The challenge with compounding for most people is that in the first 5 years or so, you don't see an appreciable increase in your corpus. However, if you stay invested beyond this and keep investing, the snowballing effect starts kicking in and your corpus starts growing smartly even with reasonable returns. So don't get impatient. After all, the stock market is a place where money is transferred from the impatient to the patient investors. So you need to peg your returns expectations to a level that allows you to maximize the surplus invested and ensure you stay invested for as long as required by your goals, even through crisis and market volatility. This is we call healthy high returns or simply inflation beating returns. How high is high enough? You get the answer from your financial planning because that's where you figure out what returns will enable you to achieve all your financial goals. But from the large number of plans that we have drawn up with our clients, this is nowhere close to as high as 20%. Or a more specific answer is by managing your investing in such a way that you earn significantly higher returns than inflation and keep your discomfort within manageable levels to enable you to put all your surplus to work and stay invested in the strategy for long as you need to reach your financial goals. Let's say this is 12%, which is double of the current fixed deposit interest rate. You may wonder whether this means that at best you are destined to earn healthy but not spectacular returns. I wouldn't complain if 40 years ago someone told me this was my destiny. Remember, 1 lakh became 30 lakhs after 30 years when you compound at 12%. I can't even extend the graph to 40 years without being completely embarrassed. And there is something of a paradox that happens to returns when you manage your investing in a reasonably good returns way. As your experience and confidence grows, you take better decisions, spot high return opportunities with no real increase in risk, and learn to manage risk better. All this leads to higher returns, certainly higher than what you planned for, and that means you are moving faster than your plan to reach your financial goals. Let me summarize what we have learned in this session. You can build wealth using the wealth building formula to your advantage. It has 3 variables: the savings or surplus that you put to work, the period you stay invested for, and the returns you earn over that period. To ensure all 3 variables are working to grow your savings into wealth and to reach your goals without losing sleep, you need to 1. Start saving and investing now. 2. Save more now and in the future. As your income grows, ensure you save and invest more every year. 3. Invest to earn inflation beating returns, high enough to keep you investing all your surplus and staying invested for as long as your goals require you to. Don't chase very high returns because in real life you can't maximize the wealth building equation. 4. Get clarity of your goals. The biggest lesson here is to do everything to stay invested for long, really long, while earning inflation beating returns. Apart from investing the right way in stocks and mutual funds, you need to do a few things that will ensure you allow your investments in equity to compound successfully. And that's what I'll cover